Hello, fellow Rebel Capitals. Hope you're well. So, I wanted to go over some of the investing secrets that I just learned from a billionaire hedge fund manager. Now, a lot of you who are familiar with the channel know that I go to St. Bart's whenever I get the opportunity. If you've been to St. Bart's, you know why. But it's also because I've got a great group of friends there. Right in the core of that group, of course, is Mr. Hugh Hendry. But he knows a couple guys that were in the macro space, but they were more traders, if you will. I would put them in the category of like a Stan Druckenmiller, something like that, as far as their approach. And over this past weekend, when I was there for Hugh's birthday, I had the opportunity to sit down with one gentleman in particular and talk about strategy, talk about macro, talk about what he's investing in, what he's shorting, and how he's doing that. And I sat down with him and what he calls his office on Monday and saw what he was doing throughout the day. And the way he approaches things is he's got long-term positions, but then he'll trade around those positions. So before I get into more specifics, let me pull up a chart of one of the companies that we were looking at Monday. And I want to remind you that this is going to be a broad overview. And Friday, I'm doing a deep dive on not just this topic, but some other conversations that I had with, in fact, billionaires in other locations. It was a great trip as far as the contacts that I was able to kind of hang out with, and the information that I was able to receive is like a download from all these guys that just have incredible amounts of experience and wisdom. But there's a lot of different strategies, a lot of things that we discussed, but I'm going to be going over those details this Friday on a webinar in Rebel Capitalist Pro. It's going to be 2 p.m. Eastern time. So if you want to sign up for that, you can do a $1 trial. It's at georgegammon.com/pro. But I want to focus on the St. Bart's gentleman in particular in this specific video. So let's pull up a chart of, well, let's go ahead and start with Tesla. We talked about that briefly the other day. And one of the first lessons he shared with me, and just to give you guys some background, I call this person Steve. This is not his real name. He is a very private person, to say the least. If you did watch CNBC during the 1990s, you might have seen him here and there. But nowadays, he likes to keep an extremely low profile, and that's an understatement. So anyway, call him Steve. And he started his career back in the 80s in Japan, and he rode that up, rode that down. Then he moved to San Francisco for the dot-com bubble and bust. And then while he was, I believe, still in San Francisco, he played commodities, and then he got involved with a real estate fund. He set that up after the GFC to take advantage of the real estate crash. And then he basically retired. And then with his own account, he was playing the survey sickness commodities, pretty much the same thing we are doing on this channel. And then he rode the crypto bubble up, got out before things went bust. And now, or more recently, his focus has been on the inversion of the curve, the TLT, but hedging that position and then maybe taking a different type of macro view than he had the last time that I spoke with him, which would have been November of 2023. So one of the stocks we talked about, Tesla. And this, whether you like Tesla or you don't, it doesn't really matter. This is all about the concept and learning from these guys that have been on the front lines, and not just the analysts. But I think it's really important to get their view, but also get views from the guys and gals that weren't just sitting back and analyzing the fundamentals or giving you their opinion, but were actually making million and sometimes billion-dollar bets based on their view. That's a completely separate category of human being. Different skill set, different set of experiences, and from that you can extract different types of wisdom. The more I'm able to hang out with just incredible people, not just fund managers, but also analysts, the way I view them is like a Formula One team, and that the analysts are the engineers. They're the ones that understand every little piece and component of that Formula One car. Very, very complex. They understand the aerodynamics, everything involved. Where the drivers don't necessarily understand it to that degree. They're more like, okay, just give me a steering wheel, give me a gas, give me a brake, and I'll figure out the rest. And I have the huevos, for lack of a better word, to drive this thing around a track going 200 miles per hour. It doesn't matter how much experience one of the engineers has. They don't have the skill set. They don't have the appetite for risk that is required to take that Formula One car around a corner going 150 miles per hour. Understanding that if you don't take it at 150 miles per hour, the downforce isn't going to be sufficient and you're going to fly right off the track. That is a very rare type of human being. So anyway, I like to talk to both to get a better understanding. And at the end of the day, why not? It just makes you a better investor. So getting back to Tesla, we were using this, or he was using this as an example of when to short a stock and when not to. And the main catalyst was narrative. And this is something throughout my travels over the last 3 weeks, I heard over and over and over again from these experienced investors. This is one of the main inputs to their decision making is narrative and what's the story around the industry? What's the story around the stock? What's the story around the commodity or currency or anything like that? And I want to be very clear. You've got to differentiate long-term investors from these type of fund managers that are pretty much exclusively focused on monthly P&Ls. Because as far as their track record, the best guys and gals that I have seen do not care about anything. They have no bias whatsoever. None. They're as agnostic as you can possibly be. The only thing they care about is number go up. That's it. And not just number go up, but number go up pretty much in the next 3 months. Now, it is true that they may have long-term positions. But even if they do, they're trying to trade around that to make sure that they're maximizing out of every single possible opportunity they see. Another thing I wanted to point out, and I wasn't going to go into details, but I guess whenever I go live, I just I just download the whole thing. But another thing I wanted to point out is we look at different strategies. Like you look at Kathy Wood, you look at Tom Lee. Those are the first ones that come to mind when I think of CNBC. Or you even look at a Ackman, or when you look at these guys or gals, they have a specific strategy they're known for. And that's all fine and dandy. And if you're a long-term investor, that's great. I think that's actually the way to go. But what I've noticed is, especially this gentleman in St. Bart's, it doesn't look, at certain times he can be a trend follower. At certain times he can be a value investor. At certain times he can be a gold bug. At certain times he can be all about Bitcoin. At certain times he can be all about quantitative easing. At certain times he can be bearish the dollar. The very next week he's bullish the dollar. There is no bias whatsoever. And he's just looking for opportunities. He would never, ever say, oh, I'm not going to take that trade because that's more of a value play. And I just prefer trend following. There is no way, absolutely no way. He is constantly looking for any opportunity on the short side, on the long side, short term, midterm, long term. It just, with no bias whatsoever. I can't overstate that. Where even if he is wildly bearish the dollar, let's say, If he sees an opportunity where the dollar is going to go up over the next 2 or 3 months, he's going long. He could be wildly bullish on gold or silver or whatever long term. If he sees an opportunity to go short, he's in. And if he sees that he's wrong, he's out, and completely changes his mind. I can talk to him one month, and he's very, very bearish on the U.S. economy. I can talk to him the very next month, and he's somehow bullish, even though things really haven't changed too much. But there was just a couple pieces of information that have totally flipped him from bearish to bullish. And what's interesting is if you watch interviews with Stan Druckenmiller, he's the exact same way. That's one of the reasons why I like listening to Druckenmiller so much, because you never know what he's going to say. And just because he might be bullish on the dollar, you would think that, okay, if he's bullish on the dollar, that means he's also probably positioned this way, and this way with other asset classes. And it could be the complete opposite. And it's just fascinating. And this gentleman in St. Bart's is the exact same way. Absolutely identical. Okay. But getting back to Tesla, the PE ratio right now is right around 40. I remember because we looked it up on Monday morning. So I'm not sure where. Oh, here we go. 40. So you could say that this is wildly overpriced because it's a car company. And if you look at Toyota as an example, they're maybe 10. If you look at Ford or GM, they're probably 5. And so, sure, you can sit there and talk about autonomous driving and robo-taxis and all those things. But the bottom line is, even if they're not a car company, they shouldn't be trading at 40. Let's just give them 20. Okay, well, so then the price should come down by roughly 50%. But the thing is, if you look at this chart, you could have had the exact same argument in the middle of 2020 when the price was 143. You could have had the exact same argument at the end of 2020 when the price was 235. You could add the exact same argument right here in the middle of 2021. And each time you would have actually, from a fundamental standpoint, you would have been more correct than you are right now. Why do I say more correct? Because the PE ratio would have been even more egregious back then than it is now. I mean, if you guys, let's go back in time. Remember 2019? I can't remember when they turned a profit, but they weren't even profitable. Like, they were losing money every single year, and still the stock was just going straight up. So now, of course, they're actually making money, so they have a PE, but before the PE was infinity. At least now you can say it's cheap now based on what it was in 2020 and 2021. So my point is, from a fundamental standpoint, it was way more expensive right here, right here, right here, right here, all the way up than it is today. But if you would have gone short, you would have got your face ripped off. So what's the difference? When we were discussing this on Monday, we compared it to NVIDIA. Because back, and it might not be that extreme, but I think there's some direct parallels. And I'm sure most of you would agree that back here, and even maybe starting in 2018, 19, EVs were all the rage. Like, that was the future. Maybe not to the extent that AI is today as far as the narrative, but it was similar, that this is disruption. No one's ever going to drive again. We're not going to have semi-truck drivers. We're not going to have taxi drivers. Uber, as an example, are going to have all autonomous cars, and therefore they don't have to pay any, They don't have to pay anything to their drivers, and this is just going to completely disrupt absolutely everything. It's going to disrupt the real estate market because now you can just sit back and let the robot drive you around, and you can do all your work when you're coming to the office, so you can live farther away from the city, or where there are all these narratives or all these stories. And you could see all of the car companies were piling on. Remember, they are going all in with EV, 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 EV. And remember, even the rental car companies were doing the exact same thing without Hertz. Remember, it's like clockwork. And I hate to be, throw them under the bus here, but it is what it is. Every single time you see Tom Brady in a commercial, I would fade whatever it is he's talking about. No offense, Tom. But sure enough, you see him in a Super Bowl ad about crypto, and 6 months later, you've got FTX. And next, or maybe prior or during that time, what you see him in a Hertz ad selling EVs. And what do we see? As soon as Hertz goes all in with these EVs, now all of a sudden, the story starts to change. And how did the story change? Well, it's still that EVs are the future, but now all the car companies are like, let's go ahead and back off. We're backpedaling. We were all in on EVs, but now we've changed our mind because the demand just isn't there. And it's just not there yet. And you look at other things that are changing the narrative, like BYD in China. I mean, I rarely see a Tesla here in Colombia. I see a BYD almost every single day. So you've got this coming at them from all different angles. And let's see, I think I wanted to show you guys. Actually, I'll save that for the webinar. I had a Google search pulled up based on Tesla, EV, all these things. And almost every single article that you see has a narrative like, I don't want to say EVs are dead. I wouldn't go that far, but implying that, okay, we thought they were the future and maybe we got ahead of ourselves here. And then you see all these articles going straight after Musk. I don't think that's going to help him in the long run as far as the stock. So one of the first rules was you never, ever, ever short strictly based on valuation. Never. You always wait for the story to change. You always wait for the narrative to change. And that means that you're going to miss the top. But we're not trying to time the top at all. We're just simply trying to catch the middle of the move. That's it. So that was one. And so that the main point that I wanted to make there is if you are shorting something, or hey, I know a lot of you are really, really anxious to short the S&P 500, but it's the exact same thing there, guys. Let's pull up a chart of the S&P and look at this. I mean, was it overvalued right here in July of 2020? Yeah. Was it ridiculously overvalued 2-3 months ago? Absolutely. And it's still just going straight up. And this is why, even prior to this last trip that I took, even prior to that, I was saying, for me, I can't give you any investment advice, but for me, I would not buy puts on the S&P 500. I would not go short the S&P 500. I would just go long the 2-year treasury. Much more conservative, and it's the same play, but you can't predict if the stock market's going to rip higher. And even when the curve's inverted, you usually see the stock market go up, or I shouldn't say usually, you often see the market go up until the stuff hits the fan. When's the stuff going to hit the fan? I don't know. I have no clue. Now, taking it a step further, you know what? I'll save that for the webinar as well. Because when this former hedge fund manager goes short, he also hedges it out with a long position. But he doesn't just go short and go long. He does it using much different strategies to put on a trade that's far more asymmetric. And so let me actually just write that down here. Because I want to remember to discuss that in the webinar. So we're going to go hedge for short. And then I'm going to say structure the trade. Okay. Now, let's see. What did I want to discuss? Let's go to NVIDIA. Because NVIDIA, I think there's a strong argument. It's Tesla 2.0. And you're probably looking at Tesla like right around here. And remember, guys, Tesla did a couple stock splits in here. I believe it was 2020 or 2021, something like that. The share price went from like 200, like straight up to 2,000. And then they split the stock. I don't know if they've done it once or twice, but that might be what this black line is. Oh, no, that's volume. Sorry. But I know they did that a few times in here. So you've got to take that into consideration when you're looking at the overall price. It wouldn't surprise me if NVIDIA did the exact same thing. But right now you can look at NVIDIA and say, oh my gosh, well, yes, AI is definitely the future, but it's just like the .com. And I would make this argument long term. Absolutely. Or I would make this argument based on valuation. That sure, it's the future, but it doesn't mean that it's not overpriced. But just because it's overpriced doesn't mean that the price isn't going to continue to go up. Why? It's all about the story. All about the narrative. So you've actually got to time that. And another thing you guys may find interesting, I was so impressed by the importance of perception within the market participants, not just retail, but even the quote unquote experts, even the managers themselves. I started reaching out to people I know that are in the AI space and experts in the AI space to try to figure out a way that we could somehow quantify narrative. As an example, so I want to know on a scale of 1 to 10, or maybe on a scale of -10 to +10, how strong is the push in AI right now? And have AI itself tell me based on parameters that we kind of model. So you type in, what you want to look for as far as a trend, and then it tells you how powerful the trend is based on social media. So, I mean, just simple stuff. You look at Google Trends, but in addition to that, I was thinking of one of the inputs for this AI model would just simply be how many YouTube videos are being created right now around this specific topic. And how many views are they getting relative to the views that channel normally gets? How many thumbs up? How many times is it shared? The engagement that's involved. And you look at that for all the platforms on social media. You try to mine all of the blog posts that are discussing this, everything on LinkedIn, all the tweets. Now, it's a whole separate issue when you're talking about whether they have an open API, and I've gotten into the weeds on this stuff. But that's the overall concept, because I believe moving forward, we're going to likely be in this cycle where you have recessions that are where the response mechanism to the recession is going to incentivize the retail investor to just YOLO, risk on. So even though my base case is for stuff to hit the fan and yield curve being right, like I've said from the very beginning, I think the response mechanism to that is going to possibly be very, very bullish for the market, and maybe not for the entire market, right? We talk about breadth all the time. Maybe not the entire market, but those specific stocks that are in the, or assets that are in the YOLO category. And how do you measure that? Well, that's what the AI model is trying to quantify. And not that you're trading or investing based solely on what the algorithm, if you will, is telling you, but using that as an input for everything else to try to pick up on what the trend is. And also using that for value. Another main takeaway from the trip was that at the end of the day, everybody's a trend follower. Jim Rogers, he'd never consider himself a trend follower, but he is. He just starts with value, and that's how he isolates what he's interested in investing in, but he always looks for a catalyst, which means he's looking for a trend. So you take all these other inputs with trying to find a trend, you combine that with this, if you want to call it a quantitative model, might be a stretch, but and that's giving you a more robust system to use moving forward. And again, I want to be very, very clear. This is not meant to be a video or to be discussing any type of strategy for a long-term play. As most of you know, for me with long-term, it's just simply cash position, T-bills, and again, not investment advice, just what I'm doing, and gold. Gold is always there. And then waiting for the best opportunity. The way I look at my long-term portfolio is more like a Black Monday type of setup. And for those of you who are Rebel Capitalist Pro members, you know that I talk about my sister quite often because my sister probably has the best returns of any person I've ever seen in the last 10 years. And this is just, and it's exactly what she actually used to do, is she wouldn't buy, my sister's got a lot of money, and her family is, well, I won't go into it, but she can afford to shop at Louis Vuitton. She can afford to shop at these places, but she never would. Even the last 20 years, she never, ever would. She would always wait to Black Monday to buy pretty much everything, even for my nieces, even when they're young, going to school. She wouldn't buy them anything. She just wait till Black Friday. Was I saying Black Monday? I meant Black Friday every single year. And that's the exact same way that she invests. So that's one type of portfolio. But what I'm talking about now is something completely different. It's more so, what's my monthly P&L and how can I focus on that? How can I make money today? And the best hedge fund managers that I've ever met are able to compartmentalize. They're not just short-term traders. They're not just long-term value guys or gals. They're both. They're everything at all times based on wherever they see opportunity. And I'm not saying that you should do that. I'm saying if you want to do that, this is how the people that I have met play the game. Okay, I think we'll go ahead, and I've got a lot more to talk about, but we'll save that for the webinar and diving into some of the tactics and a lot more of the strategies that I kind of just briefly went over. So if you want to participate in that webinar again, just go to georgegammon.com/pro. And guys, thanks for hanging out with me today. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.